Hi everybody, and welcome back to the Middle Class Investor. It is Sunday, June 22nd, and we've had a new high in the market, as you know, those of you who have been following. We've also been looking at this rising wedge pattern, which we are persistently on the high side of the pattern and watching it closely. The simple fact, I guess, is that we're running out of room on this pattern. I suppose it's possible that this breaks out and we actually continue to go higher. The pattern looks almost complete to me. We went from this low down here. We've made what looks like a very normal move in the market up, and now we're at the higher point. We could make a slightly higher high on Monday, but I think if I had to predict, which predicting is always difficult, I would say we make maybe a slightly higher high, and then we begin to sell off from there. So the pattern, the fact is around this pattern is that it's held for such a long time. I think it would be highly, let's go back like 5 years, and you can see that the price action is narrowing inside this pattern, and it's actually been holding for a long time. So I would say that this is likely some type of throw over. You can see it on this larger scale. It hardly even looks significant as compared to, like, say, this one down here, or even these here. These here are even more significant than this one up here. So let's see if we can see that a little bit better. You can see here what I'm talking about. This throw over to the downside was more significant, and even this throw over here to the downside was more significant so far than this one. So we might get a slightly higher high, and then we might then begin rolling over to at least this bottom part of the pattern. That's what's likely to happen. One of the things about investing or trading, I mean, it's more really of a trading principle, but the principle in trading is that if you're in a trend, the probability is that the trend continues. So the trend is obviously up here. The probability is that the trend continues. The problem with this particular trend is it's narrowing so much that it's likely, this is likely to be some sort of change in trend. Now, it doesn't have to change, in one day. I mean, it could kind of slowly go sideways and then roll over and then kind of go down, or it could change in one day very violently and then come back and retest and then proceed further. It just depends. I mean, the market's always different. You just have to, but that's why you want to consider what might be possible before it actually gets there. So for example, we might look for, I don't know, let me nuke that. We might look for this to kind of come down, like so. Remember, the market kind of jags its way down, and I don't know, we've talked about this before, about it kind of coming down below this area, maybe into this support zone, and then kind of make a move back up, like into this area right here. And then, and generally the way it works, if you have a trend change, the first move, you look for if you can identify the first move in any one direction, either up or down, and then you look for a correction into that move. The third move in the direction of the initial move is usually pretty significant, and you can even see that. You can even see that here. You can, if you look closely, you can see this first move up, and this now this is the time frame is much smaller here, but you can see this move right here, and this is exactly what I'm talking about. This particular trend right here, this was the bottom of this trend. We had a move off the trend, we had a correction back, and then this next move up was really significant compared to this. So that's the kind of effect you see here. If you envision this being the first move, this being the correction into the first move, then this thing down through here could be this, and that's what you have to worry about. Because if this is what is this? This is about 120 points. So just look at the ratio of this distance to this distance, and then ask yourself, do you want to suffer that when it's in this larger degree here? And the answer is probably no. So that's really what we're trying to protect you from in the middle class investor. Is we're trying to identify this first move, and what you can do is you can just wait. In this case, until you get past. You can see here. If you just look here, if we waited till it got past that, now on a larger degree, this is still very, very significant. I don't know, maybe sometime I'll do the math on this and do a little exercise, but if this was our first move and this was the move off the first move and we broke out and then it continued to run, this would be very significant. So this is where we're trying to make our decision. We're trying to make our decision in an area where it makes sense to make a decision to stand on the sidelines. And that's really all you can do in a 401k or an IRA. I mean, there's not a lot of flexibility in those types of instruments, and so really all we want to do, I mean, that's where a lot of people keep the majority of their retirement income. And so really what we're just trying to do is, just help people make a good decision if they choose to make one. Now look, nobody's got a gun to your head. You don't have to make a decision. But for those of you that do want to stand on the sidelines, and look, what we're trying to, just to refresh your memory, what we're trying to avoid is one of these situations here, right in through here. Well, I changed charts on you. What we're trying to avoid is this right here, because the reality is, if you can let me zoom in here a little bit. If you can identify this section right here, a break of this section as being significant, and see the way we would do it. See, here's that first move down, and here's the correction into that first move. This is where we would try to do it right here. Look at what you get to avoid. I mean, this is horrible right here. This is I forgot what this number is, but it's around 1300, and it went all the way to 600 and mid 600s. So if you can avoid this and then you employ the same strategy for getting back in, over time you'll do really well in the market. I mean, that's just the reality of it. So that's the purpose of the middle class investor. That's what we're trying to help you guys do. And you can even do this in a smaller degree trend. You can kind of see this latest move up here. This was the so we could see a move into this 1965 area, and then have it kind of break down and come back through this pattern. But this first move off the bottom, and then a correction in the first move, this happens at every degree of trend. It happens on hourly charts, it happens on daily charts, it happens on weekly charts, it happens on monthly charts. If you get good at recognizing these patterns, you can really avoid some pretty bad carnage. And the other reality is, bull markets and bull markets especially last 5 to 7 years. We're well over 5 years now from this bull market, and there's going to be some significant correction. Now it could only be, maybe it's only 15 or 20%, but it's going to be a significant. It's probably going to be, if I had to guess where it's going to be, it's probably going to be down into this 1,000 area. So that's 900 points on the S&P 500. That's 50%. Who wants to give that back to the market? not me, and hopefully not you. So that's what we're here to try to do, is help you make a good decision. Now, real quick, let's go back and look at some of the other markets. Let's look at the 10-year interest rate market. Again, we were looking at this as being the first move off the bottom, possibly. We don't know for sure. I'm starting to think maybe now there might be one move lower here, just because it may not be a significant move lower, but because if the market begins to sell off, this is the classic dichotomy in the market. If equities sell off, which is represented by the S&P 500, there tends to be a money flow into bonds. So that would lower interest rates in bonds. So that would, for those of you that are still in bond funds out there, give you another chance possibly to get out of a bond fund. You do not want to be in a bond fund when interest rates are rising. And if this is the first move up, then interest rates are going to rise pretty significantly. And then they'll pull back and then rise even more significantly. So you don't want to be in bond funds while that's happening. That's a surefire recipe to lose a lot of money. So that's the bond market. We could make another low down below this low somewhere. Not significantly lower, but lower still. Let's look at the Dow. The Dow is only 30 stocks, so it's not as significant, but a lot of people still look at it. This pattern, this wedge inside a wedge, is not really working out. So we kind of go back to this pattern here, the red pattern. And if you look at it on the red wedge, if you look at it on a, let's say, a 2-year and a weekly, this pattern is still holding true. I mean, you got a high there, and then we're making another high. So this whole area looks like a throwover, in which case we could get a sell-off down to this area pretty quickly. This 15,250 area. Looking at what else? The euro. The euro is an important currency. We're watching it closely. It looks like it didn't hold support here. I haven't drawn a new box, but it'll either bounce. I know this sounds kind of obvious, but it'll either bounce and make a new high, or it'll bounce and make a lower high and then come down to another level of support, probably in this 134 area, or maybe even in this 132 area. So we'll continue to watch the euro. The reason we want to watch the euro closely is because there's been a pretty tight correlation in the stock market between the dollar, the US dollar, and the stock market. So as the dollars become weaker, i.e. the euro becomes stronger, the market has climbed. But if that trend begins to reverse, if the euro becomes weaker and the dollar becomes stronger, then the stock market is likely to decline. And so we can use these other markets as confirmation of what our thesis is. All right, everybody. Well, I think that's about it for the week. There's not really much happen. It looks like maybe in the next several weeks we'll get a little bit more happening we can look at. Forward the link to your friends and family, those that are interested in that have money and are interested in keeping their money. And keep coming back to the middle class investor. We're gonna keep you out of trouble. That's our goal. Of course, you have to kind of follow and take the instruction. But if you do that, we ought to be able to keep you out of trouble. So follow me on Twitter at InvestorClass, and you can go to YouTube and search under Middle Class Investor, and you can find all the videos there. I don't know how many there are now. There's several. There's probably 20 or so. So you can go back, listen to those videos, see how we're talking about these moves as they move up. I mean, I'm trying to be pretty consistent. As long as we're inside this pattern, then these red lines here, then it's pretty bullish or sit tight. I wouldn't add to your positions, but if you're in, and as long as we're in this pattern, inside this red pattern, I would just sit tight and don't do anything. You could take some profits. There's not much more here, as evidenced in the last several weeks. I mean, really back from here, difference between this high at 1903 and this at 1962 is not really all that significant given the risk of the downside. So, okay, everybody, that's it for the Middle Class Investor this week. Keep coming in, keep watching the videos, and let's keep each other out of trouble. Thanks a lot. Have a good one.